Hello and welcome to this edition of the Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank. Joining me today is Rob Romano, our Director of Research. This is our first of 3 videos as we discuss our 2026 investment outlook. Rob, it's been a great 3 years for equity investors. Why don't you start out talking about margins and earnings and how well that's gone?
Sure. We've had 4 straight quarters of double-digit year-over-year earnings growth and 5 straight quarters of profit margins greater than 12%. So corporate America continues to be relentless on cutting costs, keeping costs in line, and we're starting to see some of the early benefits, and I say very early benefits of artificial intelligence and increasing efficiency and productivity. A couple examples here. One is Amazon. They've talked about using more automation within their distribution facilities as a way to move parcels and packages. And they mentioned a couple weeks ago they have over 1 million robots in place today, and they expect to expand that significantly over the next couple years. Next company, C.H. Robinson. They're an asset-light logistics provider, and they are using AI agents to better manage that workflow. So all the way from the pricing of the freight to the ordering and processing to managing and tracking of that freight. And on this chart, you can see here I have a couple lines. The orange line is profit margins. And you can see the significant uptick in profit margins. The black line is price to earnings ratio. And that is the market. That is the market saying, we're going to put a higher value on those earnings, just given the level of profitability. So as we head into next year, there's some additional benefits for corporate earnings, and that's through the One Big Beautiful Bill. And with that, you'll see immediate expensing of research and development. You also see some accelerated depreciation. Now, this won't change the statutory tax rate, but it will have a fairly significant effect on the effective tax rate.
So essentially another tailwind for equity markets. Obviously, you briefly mentioned a couple of the impacts of artificial intelligence. We're starting to see our own improved efficiencies at the bank. Why don't you talk a little bit more about AI in general and how the market's dealing with that?
Yeah, we're big believers in artificial intelligence, but I will caveat that with over the long term. With many of these, technological revolutions, markets can get ahead of themselves. And we're seeing that in some of the announcements. Really, some of the announcements are staggering. When you think about it, NVIDIA investing $100 billion in OpenAI, OpenAI and Oracle sign a $300 billion deal, and that's to rent out data centers, to use their OpenAI can rent out their servers. And these are data centers that really aren't even built yet. And there's questions around OpenAI and really their financial capability of entering into a deal of this size. OpenAI is a private company. They have provided some level of financial guidance, but they do expect sales to increase significantly. But in turn, cash flow is going to be negative until 2029, and cash burn is going to be $110 billion. So we are, we're scratching our heads and we're questioning some of the return on investment in some of the artificial intelligence, especially when you consider, just the overall cost of the data centers, the energy usage, which is tremendous. Again, as an example, the OpenAI Oracle agreement, that is for 4 gigawatts of power. That's equal to 4 nuclear plants. And what we do know is that a search on an AI tool like a Gemini or ChatGPT, that is 10 times more energy intensive than a normal Google search. So again, with some of these new technologies, there's a lot of excitement, euphoria early on, so it tends to get overestimated. But I will say longer term, the benefits tend to be significant. And we've seen that in prior episodes of technological revolutions.
Yeah, if you go back to the early 2000s, that's a great time period where we saw great advancement, but that doesn't mean everybody makes money.
Yep.
And it really was the second wave that we got the true benefit. And so we'll have to see how that plays out with artificial intelligence. Lastly, Rob, when we think about expected returns going forward in 2026 for investors, where you start at matters. And we have some elevated valuations today.
We do. And I just wanted to revisit valuations because, whatever metric you look at, whether it's price of earnings, price of cash flow, valuations are definitely at the higher end of the range. Now, I will say there are segments of the market that are more reasonable. And on this chart here, we want to show that. So what we're comparing here is valuations in 2015 to 2025. And we're looking across price of earnings, price of cash flow, and price of sales. And we're using three indices, the S&P 500, the S&P 500 equal weight, and the Russell 1000. So in 2015, the valuation of the S&P 500 was around 17. Today, we're closer to 23. So you can see it's a fairly significant step up. When we look at price to cash flow for the S&P 500, the story is fairly similar. You can see a significant move higher in valuations. But when we look to the other indices, the equal weight and also the Russell 1000 valuations are much more, I would say, comparable to where they were in 2015. I wouldn't say they're cheap, but again, much more reasonable. So when we consider the elevated valuations and the concentration in the S&P 500 with the top 10 equaling roughly 40% of the index, we think diversification is more important than ever. And that is why our investment committee continues to look for opportunities outside our large cap weighting and core S&P and growth, and to diversify into other asset classes like international, mid cap and small cap, dividend securities, and value.
So clearly we believe, and that's part of our core investment philosophy, is to have a diversified portfolio. Mm-hmm. And right now that hasn't paid off quite as well as we would like, but we know long term that really helps our clients. Rob, as always, really appreciate your insights and your outlook for 2026. If you enjoyed today's video, I encourage you to share that with friends and family. If you do not currently subscribe to the Market Share, you can do so using the QR code at the end of the video or emailing us at wealthadvisory@firstsource.com. And as always, thank you for the opportunity to serve you and your family, and have a great holiday season.